Why are spreads so profitable, and how do you use them with a small portfolio to grow it quickly? Well, in this video, I'm going to cover as fast as possible the 4 different strategies I use with spreads to make money. The first strategy we're going to be talking about is going to be a call credit spread. Now, specifically, I use call credit spreads when I want to make money on a stock not going up. Okay, so if you think a stock is expensive, you can use a call credit spread to collect some income up front. And if the stock does not go up, you have just made yourself a really big return. Let me show you what this looks like. So first of all, you want to look at the stock and find where exactly you think it is having a resistance point. So right here on Tesla, 262 is roughly the resistance if we just take a look at the chart and nothing else. All right, so let's just go with 262. Obviously, you want to do a little bit more technical analysis than that. I just want to show you how these strategies actually work. So if I go to sell call, this is how you would open up a call credit spread. Now, Tesla's currently at 219, so I'm gonna go out into the future because obviously 262 is quite a while away, so you wanna give this option enough time. What happens is if you don't give it enough time, for example, let's go for a really short expiration day. If I go to 262, it's not really worth anything. In fact, even the 247 strike, the 245, it's really worth nothing. And that's because obviously option traders understand that this stock cannot go that high in such a short amount of time. So instead, what you want to do is you want to give this option enough time for expiration. So let's just say we go out 62 days. Now I'm going to go up, up to 262 or thereabouts. Maybe we'll do 265. If I expand this option right here, you will see that the delta is 0.18. That is a really good sign. One of the most important things that you want to look for is delta. So if delta is really high, that means that there's a very high risk when you're selling options. If delta is low, that means that the chances are pretty good that this option is going to expire out of the money. And that's what you want to happen. When you're selling options, you don't want the stock to go in the money. Instead, what you want to happen is you want to collect income and you want nothing to happen. You want the stock to either stand still or not go towards your strike price. Because again, if it goes into the money, then you will be losing money. You potentially have to manage that position by either closing it or rolling it higher. Now, taking a look at this call credit spread, we open this up by going for 265. So we sell the 265 right here. We collect $385. Now, what you can do is you can go buy a call option. The reason why you want to do this is specifically if you sell a call option, that opens you up to unlimited risk, and you most likely can't do that. To open up a proper spread, you need to buy one option and sell another option. Now here in this example, we are selling the more expensive option, and now we're going to buy the less expensive option. This is going to create a spread, and my optimal difference for a spread is about $5. That means you're risking $500. Now, sometimes my optimal spread gap might be $300 or $1,000. There really isn't an optimal. It just matters what the risk to reward ratio is. And that's why risk to reward is the most important metric that I personally look out for. So 265, I will go and sell that. Now I will go ahead and buy the 270. And you will see that I have just opened up a call credit spread. This is just one of the 4 strategies I'm going to teach you in this video. So the call credit spread right here, you can collect $50 or roughly $60, and you're risking $440. Now, why would you do that? You are risking a lot of money, okay, and you're only collecting a portion or a small amount of money. That's because the chances of this actually happening is fairly low. We looked at the delta, it was about 0.189, which means there's less than a 20% chance of this actually going to the money. But the return here is also about 20%. So you might be thinking to yourself, what is the point of option trading if I'm collecting about the same money as my risk is? Well, the truth of the matter is you're gonna wanna do more technical analysis. This is just how to set up the position. If you wanna learn technical analysis, there is a video in my description that you should watch around technical analysis. Now, to continue with the rest of the 3 strategies, I'm going to also show you a call debit spread. Now, before I wrap up this, right here you will see that the only way you will start to lose money is if Tesla actually goes above 265. And then also, even at 265, you won't necessarily lose money yet. You'll actually lose money at 265.60 because you've collected $60. So it's gonna be 265.60 right there. Yep, and that is your break-even price. Anything above that, you're gonna start losing money. So this is a bearish strategy, but also you can see how the stock could literally go up. It can go up to 230, it can go up to 240, it can go up to 250. You will still make money. And that's what I really like about the call credit spread. There's a lot of leeway room. There's a lot of room for you to actually make this income, and it enters your account right away. And then you don't really have to do much managing. In fact, if the stock goes sideways, down, even a little bit up, you are totally okay. Now, something I'm going to be talking about on this channel a little bit more is going to be some buying strategies. I think there is a place and time for buying strategies. I'm going to show you a call debit spread. So for example, and we can actually get really interesting with this. I'm going to show you maybe a different strategy in this video as well. But let's just say that you think Tesla is going to rise. Let's just say based on the technicals, you think that it's going to go up 10, 20%. What you can do is you can buy a call option that is right there near the money. Okay, near the money, it's at 219. You can buy the 220. So if you buy the 220, okay, what you can do from there is you can now sell. Okay, this is the reverse. You're buying a more expensive option, and now you can sell a less expensive option. Obviously, if you just buy the 220 right here, you're going to have to spend about $1,700. But if you want to reduce that cost with spreads, and this is why they're so powerful for growing a small portfolio, it's literally probably the best strategy for growing a small portfolio next to iron condors as well. I'll put that video at the end of this. After you finish watching this, I'm going to show you iron condors. But go to sell call right now. And if I sell, let's say the 230, this is going to be a bull call spread or a call debit spread. There's two different names for it, both the same thing. Here you can see that this is actually a very interesting play because you can double your money. The maximum loss here that you're putting up is only $445. So instead of putting $1,700, you're only putting up $445, which is just a small fraction. This is a strategy that, again, I would use for small portfolios. When I was working at Goldman Sachs and in the hedge fund world, they were not necessarily using this strategy as much because they're working with larger capital. But if you have a portfolio that's 1,000, 3,000, 5,000, even 10,000, or even a little bit more than that, you're going to want to use smaller account strategies like the call debit spread, because here you can get a lot of exposure. You can get a really huge return, but obviously manage your risk. Don't put too much money into one single trade. You want to spread your risk around into 12 to 15 different positions. If you're using buying strategies, I would limit those to only maybe 30 or 40% of your portfolio at most. So here you'll see that $445 is what I'm putting up, and my potential gain here is $555. The break even here is you need Tesla to actually go up to 224, which is not that hard at all. The stock can go, past 230. That's actually where you realize your full profit. So if it's at 232, 235, 260, 1,000, it doesn't really matter. As long as it hits 230 and it stays above 230, you will realize your full profit, and it no longer benefits you for the stock to go up. That's why this is a cool strategy, because you have a defined risk and a defined return. So you know exactly what you're putting up, you know exactly what you're going to get in return. As opposed to just buying a call option, yes, you have unlimited upside, but your break even is also much higher and you're putting up much more capital up front. In my opinion, if I'm going to be using some buying strategies, I would rather use spread buying strategies than just plain simple call options. I'd rather do call debit spreads. Now let's talk about really expensive stocks and how you would play them using put options. Okay, there's two different types of put spreads. Let's first talk about the put debit spread. That's something that I have not really talked about on my channel a whole lot. This is actually a strategy that I don't personally really use, but again, there is a time and place for this. And specifically, if you look at a stock like Nvidia, I'm gonna be honest with you guys, I'm personally losing money on Nvidia. This is the only position in my portfolio where I am down money. I'm down $9,000, $9,900. So down quite a bit here, and I'm just being authentic and transparent here that I'm not perfect. I lose money too, and not everything that I trade is always gonna win. So my opinion on Nvidia is it's expensive. So yeah, let's just talk about the put debit spread strategy. So I think the stock's gonna go down, but so let's just go to put debit spread. Again, this video is not about my views. This video is about how to actually use these strategies based on your views and how you do your own research. So let's go to buy put option. Okay, that's how you start off with a put debit spread. And again, let's just say in the short term, let's just go to 27 days. Expiration date is kind of interesting because sometimes with a buying strategy, you might want to go really short term. Say you're playing earnings. You may want to go 3, 4, 5, 7 days, whatever. You can also go medium term. I would not really recommend long-term buying spreads. They can work, but the market is not really going to go down long-term. Over the long term, the market goes up. So I would not really use a put debit spread strategy like this for a long-term trade. So let's just go to 27 days. And I want to be pretty aggressive. I'm actually going to show you two different variations of this put debit spread. There's a couple of different ways you can do it. So first of all, we can actually go for an in-the-money put debit spread. Okay, so this is actually gonna have a higher delta than 50. Yeah, it's 60 because it's in the money. So I'm gonna go to buy put. Okay, so I'm gonna buy this. Now that would be pretty expensive, $2,600. And now what you would do is you would just sell a put option, because remember, a spread is just a combination of two different options. Okay, you're buying one, you're selling the other. If you are buying the more expensive one, then obviously you are spending money, it's gonna be a debit. If you're buying the less expensive one, then you are obviously collecting a credit and you're collecting income. So I prefer collecting income, but there's a time and place for a put debit spread as well. So here on Nvidia, let's say I'm very bearish, I can actually go a little bit wider with buying strategies. You don't have to go 5 difference on the spread. You can go even 20. So I can go 560, and then I can go down, and let's say that I'm going to sell the 540, okay? So here, this reduces my cost. So my maximum loss now is only about 1,000, and my maximum profit is 965. So potential return here of about 90. And this actually happens if NVIDIA goes to 540, okay? Because again, this strike price that I am selling, if it goes lower, then, well, I'm not really making any money because now this option is acting against me. However, because I'm doing two options, again, this is the definition of a spread, and then also I am reducing the upfront cost I have to pay for this position. So here, this would already be an in-the-money put-debit spread, and this position would benefit if the stock went down, which for me, I think NVIDIA will go down. But, you know, I've been wrong so far, so I don't know, I guess, what will happen with NVIDIA. It's pretty difficult to look at Tesla and NVIDIA. These couple of stocks are very, very hard to predict. Now, let's go for another position like Amazon. Just for example, I could use Amazon. I could use my favorite stock, Apple. I put quite a lot of money into Apple. But let's just talk about Amazon. I'm doing very well on Amazon. Currently makes up 6.5% of my portfolio. So let's go to trade Amazon options. You guys can tell my videos are unscripted. I'm just teaching you everything that I know because my goal is to just give you education, teach you how to actually do this. And if you want to be part of my community in my Discord, then just click the first link in the description. So I'm going to go to sell put option, and let's just say short term. Let's go over a short term example. I'm going to sell a short term put option on Amazon. Let's just say I think it has really strong technicals, which I do believe that is the case. This stock is running up like a monster. Let's just say that we want to make a really, really small account trade, okay? Let's say that we only have $500 to trade. What you would do in this scenario is you would just sell something that's really close to the money 6 days out. So you can go for, let's say, the 150. Okay, so we're going to sell the 150. If we look at the delta, it actually is pretty low. So let me actually expand this to 13 days out. I just wanted to see more strike prices. There are no more strike prices. So, okay, let's do this. I'm actually going to do the 152.5 because the 150 is pretty low delta. That's actually even a little too low for me. So let's sell this, the 152.5. And then if I go buy the 150, this is a $250 spread and you're making $71 on 179. Now what you need is you need Amazon to stay above the 152.5, because if it doesn't, below 152.5, you start to lose money with your break-even point being about 150, 179. But here, this is an option income strategy where you're actually collecting premium upfront. Now, you should also learn iron condors because they're a combination of spreads. Here's a video about iron condors that will also take your small account to the next level.